We're going to figure out where we're going to get the money from. There's a number of different sources. You should not have a problem finding a source of money because money is everywhere. Deals are harder to come by, but money, the world is pretty much made of money. So, what's crack-a-lackin' deal makers? My name is Alex and I am super excited because today I'm going to be showing you how you can invest in really big real estate with zero money of your own. Literally zero money. There are ways you can do it, especially if you're young, because if you're young, you probably don't have a lot of money. Just like me, I don't have enough money to do my first deal, but I'm going to do my first deal and I'm going to show you some of the things that I plan on doing in order to put that first deal together. So let's get right into it. Now, of course, there are some caveats to that. There are going to be some things that you have to compromise on if you want to do your first deal without any money of your own, but it's still doable. Now, the reasons you might not have money, right? Everyone knows why. Maybe you just don't have money, right? You have a job, but you use that money to pay for things, right? You don't have a rich uncle. You didn't inherit a lot of money. You didn't find a box of treasure underneath your bedroom floor. I don't know. There's a lot of reasons why you wouldn't have a lot of money. Most of them are because you're very young, like myself. So, no shame, right? There's plenty of people with not a lot of money, but you're looking to build a lot of money and build a big real estate business, which is awesome. So how can you go about getting money for this? Now, I'm going to be totally straight up with you. You're going to have to be creative because if you don't have any money to work with, you're going to have to find money to work with. Right? There's no such thing as actual zero down real estate. The money has to come from somewhere, right? There is some source of funds that the money is coming from. And it doesn't really matter where that comes from as long as it's legal and above working with the law. But other than that, it doesn't really matter where it comes from. And so it's your job to get creative and find that money and piece it together for this deal that you want to accomplish. For the purposes of this video, I'm going to be referencing multifamily apartment building investing. That's probably what you're interested in anyway if you're watching this video. It's also what I know best, so that's going to be the easiest for me to communicate to you. However, if you don't know anything about multifamily investing and you would love to learn, just like I was, like when I wanted to learn, I would highly recommend you go to themichaelblanc.com/DMC. That is the Dealmaker Certification course, and it is incredible. As someone who started out with no information at all whatsoever, it answered so many questions that I would not even think to ask because they were the unknown unknowns. And so if you want to learn more about investing, I would highly recommend you go and check that course out. It is full of so many resources, so many things between contracts, videos, case studies, things you can work on. It's awesome. Go check it out. Okay, so step one is going to be figuring out how much money we actually need. Once we figure that out, we're going to figure out where we're going to get the money from. There's a number of different sources. You should not have a problem finding a source of money because money is everywhere. Deals are harder to come by, but money, the world is pretty much made of money. So keep that in mind. What parts of the deal require money and how much do they require? Well, I'm glad you asked because I'm going to get into that right now. So first up is your earnest money deposit. And this is money, typically 1 to 2% of the purchase price that you put up with the seller after the letter of intent is signed. And to explain that a little further, when you put your letter of intent down, that's showing that you are interested in buying the property and it shows the terms of which you are interested in buying the property. And it's typically, like I said, 1 to 2% of the purchase price. So depending on the size of your deal, this is probably going to be the biggest expense that you're going to have to pay up. Now, keep in mind that a lot of the expenses that I'm going to go over are reimbursable at closing. So once the property closes, you can then pay yourself back from the property fund because those are all upfront expenses that you had to cover. With the deposit, you're going to put this up to show the seller that you are committed to the deal. At some point in the process, you're going to have to forfeit that deposit. It's typically after inspections, but it depends on what the contract says. So once you say, okay, all the inspections are good, I'm ready to move forward with the property, you waive the deposit, and so that if the deal falls through, you can lose your deposit. So that's something to keep in mind, and that's why you want to make sure that you are totally certain after inspections that you're going to go through with the property. Number two is your due diligence costs. These are typically inspections, surveys, checking the title, and other reports on the property. This is what you do when you're making sure that everything checks out in the property, right? So at this time, you're going to be checking leases to make sure all the numbers line up, checking financials, backing up your investment criteria, and checking the market again. It really depends on this, especially on the size of the place. So if you're looking at a 300 unit property, your inspections are going to be much more expensive than something like a 50 unit just because of sheer size. And so you can expect inspection to cost anywhere from $5,000 to $30,000. Title is a few $1,000s. It's really hard to judge this. Title, stuff like that will depend on where you are in the country. And so a lot of this is really dependent on a number of factors. And so you're gonna have to consider that and kind of do some mental math on your own because I cannot speak for every single state. Number three are going to be your attorney fees, your SEC filings, and your entity formation formation. When you set up a property, you're going to have to create an entire LLC just for that property most of the time. The bank will usually require that. Now, these costs are typically around $10,000 to $20,000. They shouldn't really change much depending on the size of the deal. Some deals that are really big, like 20 million plus generally, the bank will require a couple extra LLCs to hold different parts of the property. And so that might throw your cost up a little bit, but generally it's in the ballpark of $10,000 to $20,000. You can maybe stretch that to 25, but if you're doing your first deal, it's probably going to be somewhere in the $10,000 to $15,000 range. Number 4 are your bank fees. Now these are going to be upfront, so you're going to have to put up around a $3,000 deposit with the bank, and that will go towards your appraisal. Also, appraisal can get more expensive, once again, size of the property, because they're going to have to go and look at the whole property, and a really big property may take longer than a smaller property. And so there's the appraisal and the deposit that you put up with the bank for the appraisal, as well as some legal fees and bank document processing fees that you're going to pay to the bank. Expect this to go anywhere from $5,000 to $10,000 depending on the size of the deal. Number 5. Now I know I said that the deposit was going to be your largest expense, but that is not entirely true. What's going to be even bigger by about a factor of 20, is your down payment on the property. You're gonna have to put typically around at least 20% down. There are methods where you can put less, but this is just ballpark baseline. And so you're gonna have to find money for that. Now, if you're syndicating, this is already figured out for you. You're going to be going to investors and they're going to invest in that part of the property. But there are other ways to do it other than that. And so I'm gonna walk you through a couple of those in a little bit. And number 6, I just wanted to throw this in here because this is a cost, but it is the other 80% of the property, right? So if you have the down payment of 20 to 25%, the other 75 to 80% are gonna have to be paid by somebody. Now, this is almost always, unless you have a lot of money in the bank, which you don't, if you're watching this video, I'm assuming, this is almost always going to be financed by a bank or credit union or other large institution. So this is where it's debt, basically. So now that we know what the costs are going to be, we have to figure out how we're going to find the money. Because let's just say you're going to do this with no money, right? Which would be nice. That would be awesome. Maybe you do have a little bit of money. So now maybe you can cover those costs. That's awesome. If you can do that, then go for it. It'll make the process so much easier and much more streamlined. And it will let you walk away with a bigger percentage of the deal because you won't have to give that percentage away to someone who can front those costs. So that's something to keep in mind. But where are you going to find the money if you don't have the money to do these things? Your first option is going to be friends and family that are willing to take a risk on you. All of the costs that I mentioned, except the down payment and the rest of the property, are what's called risk capital. So that is the most at-risk capital should the deal fall apart before the closing date comes. Let's say you're a week before closing and the entire deal falls apart. Well, you forfeit all the money that you spent on the reports, inspections, survey, title, and your 1% to 2% deposit, which is going to be your biggest cost that you're going to forfeit. And so it's important that if you're going to friends and family to ask them to invest with you as risk capital, it's important for them to know how risky that investment is. It is considerably more risky than just investing in the 20% down payment of the property like a syndication. Now, your next option are going to be wealthy partners. If you just have a partner who has $10 million in the bank, well, then they're going to be able to cover everything. Maybe you're going to joint venture with them, right? So maybe they can cover all of the risk capital and the down payment, and then you just get a loan for the rest of it. In this case, you're going to get a much smaller part of the deal because you're not really bringing much to the table. You're not bringing money, so maybe you're just bringing the deal and you're doing the inspections and you're managing it. So those are things to keep in mind, but a first deal is a first deal. And so it's important that you take all those things into account because all you need to do is get your foot in the door. Now, your third option is one that I already mentioned, and that is if you have money of your own. If you have money saved up, I would highly recommend taking this option, and that's going to be one of the risks that you take, but it'll make it so much more frictionless to closing your first deal. Okay, option number 4 is a partner. Maybe this is not a wealthy partner, but maybe it is a partner who can upfront those risk capital costs. Now, you would still have to syndicate this deal if your partner doesn't have the money to put the down payment down, but this also gives you an option where you can raise some of the money yourself and get a bigger piece of the deal. This is a really great option because if you have another partner, this is someone who can balance out with your strengths and weaknesses. And so maybe you're really good at raising capital, but you don't have any money of your own to do the deal. Well, that's a case where they can bring the risk capital and you can bring the money and then put the deal together amongst yourselves. And that's really awesome. Now, the last option I'm going to talk about is a very creative one that a friend of mine actually put together and exclusively does, and that is seller financing. You might know him actually. His name is Cody, and Cody has done a couple videos on this channel actually, and he has been on the podcast with Michael. Speaking of the podcast, it is the michaelblanc.com/podcast. There are so many awesome guests, one of them being myself, so you go listen to that. But the idea with the seller financing is you go to the seller, right? It's typically on smaller properties. The bigger the property is, the harder it is to get seller financing, just because it's more sophisticated sellers who don't want to finance it, they just want to sell it and move the capital to another place. But this is really great for doing a first deal because it requires zero money of your own and you can still own most of the deal. And so the way it works is you go to the seller, you build a relationship with them, right? And you ask them to finance most of the property. And so maybe they're going to finance 90% of the property and you only have to come up with the 10% down payment. Well, remember, it's a smaller property, so your 10% down payment is going to be a lesser amount. So what do? Because you still don't have that. You go to one investor who can cover the whole cost of that, and then you tell them that you're going to be 50-50 partners because they're only putting up 10% of the deal and you're putting in all the work, getting the seller financing, getting everything. And so this way you have a way better chance of getting to close without using any of your money. Obviously there's still risk capital, but this investor can, and probably will in this case, use the risk capital if you don't have any to do it. Now, I really wish I could speak more to that, but you're going to have to ask Cody about it because he is the expert. He has tons of resources. If you reach out to him, you can find out so many different really cool ways to get into seller financing, and it is really good for someone like you, or if you're like me, who is 18 with no money to invest in your first deal by yourself. So go check that out. Now, with that said, remember, these are lots of different options, so you can pick any one of them, and there is no wrong option to pick. The amount of money that you need depends on the size of the deal, and so if you're doing big deals, some of these options might not work for you. If you're doing smaller deals, some of these options might not work for you as well because it just depends on the size of the deal. Remember, you can find money in really cool places as long as you're creative. So be like Cody, be creative. Cody's creative and Cody is on his path to 100 units. And by the time this video is done, he actually might already have that done. So isn't that awesome? And if you want that for yourself, remember, be creative. Creativity is what will win in this business for you because you're young, right? So you have to get creative if you want to be successful. With that said, I'm going to wrap this video up. It has been a pleasure speaking with you today. And remember, if you want to see more videos like this, subscribe so you can keep up to date on all of our content. And if you hit the like button, it will tell the algorithm that you like these videos, and so it's going to push more to you. So I hope you give us a chance. Remember, if you have any questions, I love answering questions and I need video topic ideas to knock out. So comment them and I will answer them. Last up, we have tons and tons of resources. If you just go to themichaelblanc.com, there are tons of resources, both free and paid resources, and you might want to check some of them out because a lot of them brought me to where I am today, and I would highly recommend them. With that said, I have been Alex, and I will see you next time. Bye.